Welcome to our 6th edition of Finance and Foundations with myself, Chris Brito, my business partner, Joe Eden, and our special guest today, local developer in Essex, Mitch Nunn.
Thanks for having me.
So, Mitch, you've been on quite an extensive property journey. So we thought we'd get you on here today to kind of give the audience a bit of a background of that journey, trials and tribulations, but, we can evolve the conversations as we move along. But I guess it'd be good to start with, what actually got you into property in the first place and kind of how's that journey evolved over time?
Yeah. So, my first experience in property was when I bought my first house, overstretched, bought 3-bed, semi-detached house, which I probably couldn't afford at the time. And realised that, I had to do something about it. So I rented out 2 of the rooms and I lived in one, and I thought, wow, that, £500 a bedroom, £1,000 a month. That was probably leading me into HMOs.
I was going to say, is that like your mini HMO to start the journey?
Years ago.
When was that roughly?
So I bought the house in, I think it was coming out the back end of the great financial crisis. I think it was like 2009, 2010, something like that. So yeah, bought 3-bed semi, 205 grand.
I've got to ask, how were those housemates like you were living with? Because obviously close proximity. We're in now 2 of the rooms. Like I've done renting with another person before, but how was that for you, renting with 2 other people?
Well, it's always difficult living with people you don't really know about. But when you think, well, I'm getting £1,000 for 2 bedrooms, and that covers all of my bills and all of my mortgage. So that was probably my first experience. But then, really, from there, I then started picking up buy-to-lets. So I made some money trading the stock market. And then coming out the back end of the great financial crisis in 2012, I bought my first apartment. So I had a relationship with some guys I knew down in Portsmouth, and they were doing commercial to residential conversions. Mm-hmm. And yeah, I just basically was buying off plan through them. Mm-hmm. So I managed to acquire quite a few buy-to-lets down in Portsmouth, and really that got me on my journey. So yeah, first buy-to-let was 2012. So yeah, blimey.
And how was that like buying something so far away from where you're based, like down in Portsmouth?
I remember the first 2 that I was buying, and I didn't really understand the process because I'd only ever bought my own house. Yeah. And I was sort of doing a deal with these guys, buying off plan, and there was a bit of a developer's gift within that, and I was thinking, I'm blatantly getting scammed here. But I'm going to give away my age. 2012, so obviously 14 years ago, so maybe 25 at the time.
Was you exchanging on them units then, off plan?
Yeah, before it ends. But so I just acquired, and actually over that period, I think from about 2012, can't remember when I bought my last ones, maybe 2015, 2016. Actually bought 18 single let. 18 single let, buy to let.
Same block?
No, it did different blocks. So as they did different different developments, I just bought, I'll have 2 in that one, I'll have 3 in that one, and 2 in that one, all down in Portsmouth, and built up 18, which were actually all in my personal name. So actually now over the years, I've been selling those off, and I think I've got 2, 2 or 3 left. But yeah, that really got me into property. And then obviously my strategies have sort of evolved over time now into sort of what we do now.
And how was that like when you had those properties in Portsmouth, that kind of fully hands-off approach and something being so far away? We've been on, the property industry has always had this mindset, especially people living in the south, to buy in the north because it was a lot cheaper, more value for money, better rents, etc., in line with the purchase prices. Was that your kind of sentiment with Portsmouth, lower prices and a better rental yield as a result?
Yeah, I never looked at Portsmouth and thought, okay, I'll invest in Portsmouth, because I think it was purely the relationship I had with these guys, because I was buying off plan, I was getting them discounted.
That was the opportunity.
Yeah, that was the opportunity, and that's the reason why I bought in Portsmouth. Off the back of that, obviously Portsmouth's a good area. It's a highly dense area in terms of, I think it's one of the most dense places in Europe, Portsmouth. So, rents
in terms of population.
Yeah.
Not people.
Rents are really...
Not people.
Is that what you mean?
Yeah. So rents are really high. So, so it was just through the opportunity that I went down there and invested, really.
So you, them first few units, you didn't know loads about the market. You was exchanging on them, delay completion, getting a mortgage, and then completing on them and renting them out. Is that what you done?
Yeah. So I used yeah, so basically the first couple I bought, I basically, they were also giving me a part loan in the background. So we were just being really creative in terms of below market anyway. And then obviously they helped me fund some of them. But as we went on, I'd pick up another 3 in a block, take out bridging finance on them, and then hold on to them for 6 months.
Oh, so you was bridging back then?
Yeah, on one of them I did, picked up 3 of them on a bridging loan, and then sort of, refinanced out and
high value.
yeah, exactly. Yeah, managed to pay back the bridging. I actually think that was a private investor loan at that time rather than bridging finance, but
same sentiment.
Yeah, it's the same sort of idea. So yeah, just kept on buying them, and And
so then after the ones in Portsmouth, because obviously you start buying in Warrington as well, another place further afield. What made you start buying in Warrington?
Well, Warrington was a decision that I made because obviously, we're based in the southeast.
Yeah.
You just, if you buy around here, you just don't get any yield. So I wanted to invest somewhere up north, and I was sort of looking at different areas, and I was thinking, well, where to invest. And obviously I saw Warrington, and it sort of sat 20 minutes either way of Manchester and Liverpool. So I thought, well, they've had massive growth, and as they've become overpopulated, people start to move out. There was, good transport links. I think it was Amazon and like Hermes at the time, which is now Every. They were doing big warehouses, so lots of employment in the area. At that time, HS2 was also still, they were still powering out HS2. And at that point, you could have taken a train journey from Warrington to London in about an hour and 10 minutes or something. So technically, I was thinking, well, you could actually work in London but live in Warrington, and commute. So obviously, house prices are not going to stay where they are. And I just literally head down, invest. And I think what helped me also is having a really good agent in the area. I think because obviously we're probably best part 3.5, 4 hours away. If you didn't have the confidence in someone in the area, you probably wouldn't have invested so much. But I got a really good agent up there, and they make it really, really easy for me. So I just, as I said, head down and so I got 34 properties in Warrington.
34. Wow.
Yeah.
Do you think that was an element of? I think in any investment, there's an element of luck, but in this industry, there's so much like social media shininess. And when you've done well, it's really easy to retrospectively say, I've done this because of this reason, and I'm so intelligent, and I've done this. I'm not saying you're not intelligent. You're saying, do you think that, like, what element of luck do you think is attributed to it, like an area? Because people are looking for these gold mine areas all the time. How, like, on reflection, Warrington has done well, but was there an element of luck? What do you think?
Yeah, I think probably the agent I tripped into, because I suppose, you hear the horror stories of agents, don't you? Just mismanaging properties. I suppose, as soon as you lose confidence in because you're just not there, are you? Yeah. So you need to have trust in someone. Then, you just, I'm sure you would have changed focus. But I think because I was picking up some decent properties, obviously buying them really well, and got a combination of like flats and houses up there. No HMOs, just pure vanilla buy-to-lets. And the guys just manage it. I think I've got 34 properties up there. I think I've only been up to Warrington to visit probably about 5 times.
Really?
Yeah.
Oh, wow.
Yeah, there's just
confidence is key, right?
Yeah, I just would buy something, don't necessarily have to see it. The guys say, it's a good one, go up there, buy it, complete. They'll go pick the keys up, or they might manage it already because I bought it off an exiting landlord, and just fold it in. And so I think I bought my first one in, I don't actually know when that is now, in time is crazy, but I'd say maybe like 2018, 2019, I'd say. Probably maybe 2020, bought my first one.
Yeah.
And just I haven't bought any in the last few years because obviously as the interest rates creeped up, and obviously been focusing more on development down in the southeast.
Yeah, I was going to touch on that. So I spoke about this yesterday on a panel discussion about how, bridging finance has probably become more important than ever when it comes to properties as an investment, because I feel like the normal single let strategy of buying something ready-made and just getting a yield, it's just been squeezed so tightly because of various things.
Yeah.
and then obviously you're saying it now, that's what then moved you into more development, which is the value add stuff. So rather than just relying on a strong rental yield, you're doing the value add part to refinance, pull money out, go again.
Yeah. I mean, obviously, if you're investing down here, you get like a 5 or 6% gross yield, but your mortgage rate's still at 4.5%, 5%. It's not that sexy. So obviously up north, you can get, if you buy a 9-10% gross yield. So it still makes sense. But even in recent years, where you've got the increase in interest rate, now you've got the interest in surcharge on your stamp duty, which is like now up at 5%. It's just, I think there's too much has gone against it. Whether that changes, I don't know. Obviously, hopefully interest rates will come back down.
Slowly but surely.
Yeah, in the coming years. But and I love a vanilla buy to that. I'll definitely go back to buy the Warrington. Funny enough, I was on Rightmove this morning thinking, what house is worth up there now? Because I'd like to do some like direct to vendor stuff up there because I'd like to pick up some more. But no, I mean, our focus probably for the last, I'd say 2 to 3, maybe even 4 years has been like value add through development, build equity down in the southeast, where we can actually, we've built a really strong team down here now, so we can, we're building equity through development.
Okay, and so during this long successful journey that you've had, what would you say has been like your biggest success, but also your biggest, not maybe failure, but biggest, I guess, challenge or learning curve you've encountered?
My biggest success is probably just how consistent I've been. Obviously bought that first property in 2012, and as I say, head down, just keep swinging, just keep buying. The fact is, I've always been acquiring property every year throughout whatever that is, like best part of 14 years now. Just, everything I've pretty much had. Obviously, I had businesses, which obviously had 2 businesses, which we scaled and sold. And obviously, all of that funds went into property as well, which has definitely helped. But I think I've just been really, really consistent. In terms of the sort of struggle or failings, I mean, there's lessons in every development, isn't it?
Of course.
What I'll do is I never overstep. I think if you look at my journey through acquiring buy-to-lets, my first development was a house to 2 flats. And then I sort of did that a couple of times. And I did like a house, but actually to an 8-bed HMO, then went on to the HMOs, to the commercial to residential 7 flats. So like there's been that like natural progression in terms of size of site. And you learn across that journey on every development. So I've never really like taken a massive step. Well, maybe that's a negative, that I've just not pushed myself.
Well, I mean, the fact that you've kept swinging all the way through and you've never stopped and you've kept consistent is merit in that itself. So I wouldn't say that, but over like that 14-year period, no big fails, no big learns that you think stand out for you. It's just like you say, just learn from each development one by one.
I mean, touch wood, no massive fails that stand out. I mean, I probably really swerved one in the site, which was the site next to Mum's, which was an ex like equestrian centre, and it was like green belt, brown belt, previously developed sort of thing. And I have like big aspirations for that site. Right, it's going to be a big development plan and do that. And I think from start to finish, it took me about 6 years to get planning. And I'd funded in place on that, so I had to service the debt throughout that whole period. And that was quite challenging. But with property, time is a funny old thing, because you always do seem to come out the other side of it.
If you can weather the storm.
If you can weather the storm. So I sort of, in the end, I got planned in, and I actually even sold it before I had the pre-commencement conditions sort of finalised, and managed to get out of it. And actually now, hearing about that site and sort of what's gone on since I sort of sold it, I think I swerved a big bullet there in terms of, I think that one would have sunk me. That would have been a massive lesson. But
that's pretty big, isn't it? We see it a lot. People want to get rich quick, and they just see all these overnight successes. But that's probably one thing to not go deeper on. But like most people wouldn't, or don't know you've been in the industry for that long, and they look at what you're doing and just think, oh, it looks all shiny at the top. But even 10 years into your journey, you've come up against some potential issues that you're glad that you swerved.
Yeah.
But people sometimes want to get into the industry and go straight to a 10-bed HMO.
Yeah.
But you've slowly leveled up, and that's kind of where that is the success, right?
Yeah, 100%. I mean, obviously lenders love that as well, don't they? In terms of that slow progression. But it's definitely a lesson in that site, because it's just as I said, I managed to swerve a bullet. And I think, like I said, one of my says, like, a bird in the hand is worth two in the bush, isn't it? Because I think knowing when to sort of cut ties and change direction is quite important as well, because it took me so long to get planning, and I thought, you know what, it's next door to my mum's house, it could be a nice development, I've got to see this through, got to see it through. And in the end, I just had to put my ego aside and say,
it's one of the biggest things people put their ego
I just
side.
said, you know what, I can sell the land for 600 grand. I think it stood me in 300 and something. I can take the money now and I actually can put that in 2 HMOs and I can cash flow within 6 months. Or do I do a development which I had a bridging loan ready, teed up against it of about £1 million. I mean,
there isn't many people that would have done that either.
Plus it's new build as well, which is, not my forte. Now if you look at all of our developments, we're all conversions. So, I think I swerved a big bullet on that one.
And across that period, we talk about lending in there. You've been doing it for 14 years. You obviously started off with elements of private funding, bridging finance, and obviously term funding. Have you seen much of a change in lender offerings, strategy, structures over that period? Do you think things have got harder, easier with lenders? What's your thoughts on the lending landscape over your journey in property?
Yeah, so as I say, going back to that house to 2 flat conversion, that was the first time I ever done bridging finance. And we probably did 10 deals after that in terms of everything was development finance. So, whatever it is, 65, 70% towards the purchase, 100% of build costs, and we actually only ever worked with one lender. There's obviously pros and cons in that, because the one, if we stick, they obviously know how we work, we know how they work, we build credibility, trust and loyalty.
Do you think they become more lenient with you on certain elements as well?
Yeah, definitely. I think that the underwriting become easier. I think on drawdown, I could message you on WhatsApp, the report should be across, can I have the funds yet on their way, and it almost become like a private investor, where we had such a good relationship with them. And I definitely think sticking with that same lender, as I said, built loyalty, which I think helped. So we didn't go out to the market to look at loads of different lenders, which I know that obviously the negative side of that is, I think you even said before, look, they're not the cheapest. And actually then you need to go, okay, I know they're not the cheapest. I could go out, get maybe a better loan to value or a better rate. But I think that relationship counts for a lot as well.
It really does. It does. And we talk about this a lot, that, we get clients that come into us asking for the best rate, the best loan to value. But what that doesn't mean is that they're going to get the best process that's right for them and how they want development and builds to go.
Yeah.
You can get really, really overcomplicated QSs going out, doing reports that are just so over the top when they're not really that necessary. Like, it's not a massive build. Like 150 grand development from a resi to a 6-bed HMO. I don't believe it needs like such formal in-depth QS reports constantly for every single drawdown. And there are lenders out there now that are a little bit more easygoing, still like do asset management, still require photographs, images, information, invoices to showcase what has been done and what's been attributed to those costs before they do a drawdown. But I think it's getting easier with certain lenders, and you're right, it's about pairing you up with the right lender that's going to work with you in the way in which you like to work.
I think that's obviously where your knowledge comes in, isn't it? Because, you're not going, put it into comparison, I'm looking at rate. No, you need to go, okay, well, where does this client fit? And, who will they work better with in terms of like, in terms of projects, because they all will be slightly different entirely. So in terms of the asset management, the QSs, what's their experience?
Are they organised? Are they not?
If they get to the end of the term, and that's slightly over, how will the lender react in those sort of scenarios? Will they give them a bit of leniency? But yeah, I mean, in terms of the actual going back to your question, in terms of we've not gone out and tested the market loads, but from my understanding is that there's lots of lenders out there, and as we said previously, I think that lenders got to the point of realizing that they can't just compete on rate. There needs to be like a USP, and they need to offer something else, whether it's like a specific strategy or as I say, some form of assistance or support, or just like a slick process, really.
Yeah, like when we done like a portfolio of yours where we got a low market value, 90% towards the purchase price, because it was under market value, desktop AVMs.
Yeah.
Works really, really well, right? In that particular situation. And there's so many different lenders that are great at different funding strategies and have got their place.
Yeah.
Whilst, like you quite rightly said, price isn't a thing.
Yeah.
That's why your model, it worked well for you for all them years, because you was doing it in the same geographical patch, same model, 3 to 6, 7 beds or whatever.
Yeah.
But we're finding on the other side, the market's not, prices are overinflated. So we get a lot of clients not able to cookie cutter every project.
Yeah.
There's not enough profitable projects out there in their patches. So we'll have a client that does a portfolio. We'll use one lender for that. We'll have a client that does the same client might do a HMO or a small conversion. And that's usually where the lender choices change quite a lot. But obviously in your model, that was probably the right thing to do, because you was just cookie cutter and the lender knows what to expect every time.
I mean, if you look at our HMO strategy down here, it's like literally, the house, it's the same house, the same floor plan. It's, the purchase price on the house might swing like 25 grand. The build cost is pretty much the build cost. We had and we've done it so many times. And and obviously the refinances with obviously our exit finance, which we've used a couple of different lenders, and we're starting to refinance a few of those now through you guys, and getting uplifting vals, which is really, really good. So it's been interesting. I mean, probably like the C2 property that we've just finished has probably been a little bit outside of that remit, which we've had to sort of piece in the last few months, and we're still in that process now. But no, it has been very much, as you say, same lenders, pretty much cookie cutter sort of deals.
Consistency.
Yeah.
Like you've been doing for your whole journey, yeah?
Yeah.
And just one last point on your kind of journey. The Mitch Nunn fame on social media, in the paper for right or wrong reasons,
infamous.
How have you found that?
I mean, obviously there is value in having a profile. I mean, it's the whole reason why we sat here doing this, because otherwise, why would you? It's a form of marketing. I mean, obviously was pushing the social media quite hard across YouTube, Instagram, and definitely served a purpose in terms of, you can attract capital. Definitely helps with that, because obviously you build credibility online and people can see you've got a track record of converting deals. You can see it attracts investment, you attract deals as well. Agents want to work with
know you're a buyer.
You know you're a buyer, you don't mess around. And actually it's a bit of a, was it a feather in their bow, feather in the cap, isn't it?
Yeah.
That's the term. If they like, done a deal with Mitch, but as we said earlier, probably been slower or quieter, should I say, on social media, probably for the last quarter, 3 months, nothing crazy. This is where I haven't been consistent, but
you've still been doing deals. So that's
still been doing deals, and actually I'm more optimistic about sort of where we're at now than previously. But no, I mean, I suppose I just wasn't sure. There is obviously a negative side to social media.
So talk us more about that then. Was it something that you said that you stopped for the last quarter? Why did it come to a halt? What stopped you in your tracks by delivering consistency in the socials?
I mean, it does get a lot as well, doesn't it? I mean, for anyone that's bang on the socials, I mean, it does become quite time consuming. But also, I think there is negatives in the sense that, I was pushing the HMO Academy. I was also doing the HMO tours. We did some great events down here in Southend, getting 60 people come down for HMO tour. And that's great. And I only used to ever see the positives in that, and sort of share your journey and tell people what you do and how you do it, which is great. There's definitely, there is something a bit fulfilling within that, but then it did create competition. So the market down here is quite competitive at the moment off the back of that. Also, it's HMOs, so you do get online
trolling.
There is some interest there. Not that bothers me, but that does go on. Obviously, I found an investor who now is on an equity basis, so obviously I don't need to go out and raise funds as heavily. So yeah, I think all of those things just, I'd also rather sort of put a hold on the HMO Academy. I don't have to monetize my following. So with all of those things in mind, there's no expectation for me to create content. I do it because actually, I do it when I want to do it.
I like being on camera.
Yeah, I just, I do like sharing the journey because it is, I get some great feedback and people find it quite inspirational. So I still want to do it, but I think I've just, slowed down. But we're going to pick it back up.
Do you think did you become, not you directly, but do you think people just become really obsessed with like the likes and the views and stuff rather than, because there's a lot of people doing stuff on socials and then not doing as much in property.
Yeah,
like
you do have to realise why you do it. Like I say, I know that there's the standard things, build your profile, you can raise capital, deal flow and all that, and definitely there's a place for that. But you are doing it for external validation, and it does become a little bit addictive in the sense of sharing it, get your likes, get your views, and while it's nice, I don't feel like I'm the sort of character that needs that, but you might tell me otherwise.
What's the worst negative comment that you've had, whether it be on the Evening Echo or whether it be
it's the ones, it's on the ones on the old local paper, innit? I can't.
What was your nickname on there?
I can't actually even remember. What was it?
I can't remember myself.
I know a lot of developers get called parasites. Yeah.
Look, is that what you've been called?
I think that was me. I think I was called. Yeah, I think it was the parasite. Yeah.
You should have been on with
Mitch the Maggot.
Mitch the Maggot.
Mitch the Maggot.
I was really offended.
Was that one of your exes?
Yeah, probably.
Oh, dear.
So I don't know. As I said, look, pros and cons, great for
profile building.
Obviously, I've got a few ideas with obviously, as I said, since I put a hold on HMO Academy, I've got a few ideas with something I want to do in the coming months. So I'll have to pick the content back up for that. But
anything to share or keep
no, I just think there's a place in the market for sort of a high elite like mastermind.
Okay.
So something probably London based, get 10, 15 people round a table once a month. I think there's a place for that.
Big place for that.
Yeah. I know the Developers Club do it. But that's, I think, more development focused. I think there's a place for a mastermind about, accountability, scale, raising capital, and just general wealth building. I actually quite like the idea of bringing some sort of health and well-being into that as well. So got a few ideas, but nothing confirmed yet. So
okay, watch this space. Coming soon. And so you've obviously talked about your journey up until this point. You've been consistent. Where do you think the future of the property investment landscape lies in terms of the asset class type or development style that you're going to be going for moving forward? Where do you think that's at the moment? Like, is HMOs getting to the point of a bit of saturation, specifically maybe in your area?
Yeah.
What's your thoughts around that?
So, yes, it's competitive at the moment. We can see that through our average room rent. So probably 6 months ago was $825 an average across 100 bedrooms. That's probably down to $775 now. That's because competition's come into the market at a time when probably costs has probably increased. gas, electric, council tax, etc. And yeah, I always said I'd get to the 100 rooms, which we're probably going to surpass that with the current deals that we've got. So my focus now is not HMOs, and that's why another reason I didn't want to sort of pigeonhole myself into the HMO Academy. If my strategies were going to evolve, I'd like it to have it a bit more general. So we're now focusing on commercial to residential. We're doing 4 flats around the corner, and we're actually exchanging today on, or should be anyway. I've not had the email yet, but exchanging on commercial to resi site, which is 8 flats on the existing footprint, potentially roof development to get a couple more. So 10 apartments, sort of 2.5 mil GDV. I mean, that's really where I want to be.
Yeah.
If I can do 2 of those a year. I mean, our goal with my investors is to probably add 5 million of GDV a year, which probably corresponds to 0.5 mil rent roll. That's what we want to add every year. So, we'd need at least 2 of those deals, which I think is doable. Yeah, but definitely, I think maybe that's a little bit on me in terms of, again, like growth through strategies. So obviously I've done the HMOs now I've stepped up to the commercial to resi, now like larger apartment developments. So it's a part of that, but also, when you look at sort of the landscape in terms of investment, what's working, what's not, it's like buy-to-lets are working now. So a lot of people have switched to HMOs. That's become more saturated. So now, I'm sort of evolving into sort of
and
more
diversifying.
Commercial to resi. Yeah. People always say to me, "Oh, do you want to do like a new build land development?" I'm not interested in new
I was about
builds.
to say, have you ever thought about getting into like fresh air development or bigger conversions?
Not really. I mean, no. I mean, I just think in terms of the regulation on new build, I just feel I'm a bit old school in that I like to be able to see a building and carving it up and, refurbing the internals just seems a lot more straightforward to me. We've got our own in-house build team and we can sort of convert to sort of £100 a square foot. So, and
that's got to be a massive help for you having your own internal build team, right?
It has. I mean, we're really making deals work. Joe, you come around to see the site yesterday. Yeah,
it's
nice,
pretty cool.
Nice little development, 4 flats. Obviously you guys are doing the refinance now on the exit. So, I'm confident, we'll get all or the majority of money back out of that one. I have 4 little flats. We're hoping to do that with the 10 flats as well. So that's our strategy, probably commercial to resi.
But to be able to refurb at that cost is pretty powerful. There's not many people that can do that. Like if you're a developer and going to a main contractor or builder, you're not converting £100 a square foot.
No,
it's pretty mad.
Yeah, it's we've got, like I say, I feel on the build team side, got it pretty good. So that's sort of expanded as well over time, and obviously they've come on the journey through that time as well. So obviously their knowledge is also improving as well. So yeah, as a little outfit, I think we're doing good stuff and we'll continue to scale up. But yeah, I mean, where we get to, don't know.
And we talk about that a lot. We've just talked about your build team. So, and then again, it's that age-old thing for other investors, like how important has the other professionals in your team been, whether it's solicitors, accountants, brokers, wherever else.
Yeah.
If you found that over time, how important having the right people in the right places have been for you?
Oh, 100% in terms of your power team. Yeah, I mean, obviously your power team can make or break a deal. Whether it's, your architect, your planning consultant can kill deals, your accountant on the correct structure, how tax efficient they can make your group structure, down to your solicitor. They can make you lose deals.
Yeah.
They can make it really hard. So yeah, power team is importantly, but not just that. I think as well, my sort of goal over sort of next 5 years, I'd like to build, a £50 million portfolio. I mean, that's where we're heading. I think we're at 17.5 now, probably with the pipeline, probably takes us to probably 2022. So
impressive.
Within that, you now need to build out your team. It's not just a build team on site, but it's, it's, you actually need a back end office in terms of you might actually pull more management in-house as well in terms of trying to look for efficiencies.
Yeah, it's like a portfolio management
across
team,
your
right?
portfolio. Yeah. So we're doing that. So I'm trying to think further ahead to, what it looks like as a £50 million outfit, and then try and sort of work backwards and sort of fill the gaps and sort of push us along. So
and Kelly's been great for you in that kind of part of your film, right? Great addition.
She is great. Yeah. It's funny because she probably been with us, I don't know, 6, 8, 7 months, and now 6, 7, 8 months, something like that, I guess. And at the time you're thinking, do I need PA or do I need someone for that? And then literally you get them in and you like just bombard them. It's like, can't actually live without it now.
Yeah, exactly.
How do you manage everything? Because we, again, from a client perspective, we speak to developers, new, seasoned, and one of the biggest things is managing all of that. Like, you've got a lot to manage. Are you on site every day, or do you have like how hands-on are you?
Yeah, I mean, obviously my role is obviously find the deals, raise the finance, and take them through that. From the point of completing on the property, I mean, I've got, as I said, got the build team, so we've almost got it to the point now I can hand over the keys. They could deliver the site and then hand me the keys back. So
and they deal with building control.
They deal with building control. We incentivize them. Yes, they deal with building control, everything. And as I say, I could actually give them the keys at the start of the project, and they could actually hand them back to me. They had a building control sign off done. Obviously, there is conversations, loads of conversations within that. It's like, oh, what are we doing about this? What do you want there? What do you want to do there? But that's probably more because I'm a bit of a control freak, and that's probably more in terms of the design, which again, you could sort of outsource that, or but yeah. So I think in terms of the actual site, that's sort of managed. So I'm more a case of, as I say, finding the deals, refinancing, working with the architect to approve the schemes, and then obviously coming back to me, refinance. But then also now we're sort of building out sort of the management side. Yeah, because I said we want to bring more of the management in house to have more control. Because I think what I've realised is, when you get to, if we're, I know, 20 odd million at the moment, our rent rolls 1.5 million a year. There's loads of little efficiencies in there that actually, if you do it really, really well, you can actually make quite a lot more.
Yeah.
Plus, it's well, you obviously want control. So, we're working on that really. So, I mean, that's a forever evolving thing, but we're focused on that.
Nice.
Because you seem to fit a part-time athlete lifestyle in, as well as being a developer.
That's because
I had the next one.
Midlife crisis. just like I hit 40, and it's just like, just gonna
giving away your age.
And I'd be like an elite athlete. Actually, my Woo page is actually 35, so that's what I actually use for 35. But obviously, focused on that as well at the moment. So got the first one in May, so training hard for that at the moment. But, so we're busy, we're doing a lot, but, I think also got a good balance as well.
Yeah, nice.
Good. Cool. Any further questions for Mitch?
The last thing I think it's interesting to talk about, we spoke about off camera about the extra costs. And again, talking about it from our side, we when you go into a project, a lot of people have so much optimism.
Yeah.
And they don't think about, they'll price or guess some costs around utilities, a fire strategy, etc. What's been your kind of biggest eye-opener around the extra costs as you've kind of progressed through your career? Like, we spoke about AOVs yesterday. Some people, without being rude, don't even know what AOVs are. And they go into a project, your utility costs, etc. Some people would just say, that's going to,
What's AOV?
Automatic opening vent.
There you go, thank you.
I mean, obviously you was on site yesterday, we went through it. I mean, I think, again, going back to it, it's, going through those different strategies and taking small steps, like consistent steps to sort of evolve over time. You get all those little learnings along the way. And as I say, like you always come across an additional cost, like the 4 flats we was at yesterday, just on that one. We've done new water supply, new gas supply. We didn't have to do the electrics. There was a 100 amp fuse there, so there was enough supply, but the water was 11 grand and the gas was 15. So on that, just as a bit of context, so we're building 4 flats. So I was thinking probably about 180 grand a build cost. And obviously the water come in at 11, the gas come in at 15, that's 26 grand.
Is that just extra costs that you
On top of the money?
Well, it was sort of factor. To be honest, I didn't expect it to be that high, but where they had to take the water supply from, obviously there's quite a lot of digging. So that was an issue. The gas was obviously a lot, 15, but obviously we're running all new utility supplies to all of the 4 flats. And not just that, the layout of the building meant we had to have an AOV, an automatic opening vent. So for anyone that doesn't know, is that in the communal area, usually at the highest point, if there's a fire, obviously the fire alarm triggers, there's a control panel which then opens a window in the communal area at the higher point to basically let all the smoke out. So I had to have one of those. So I think the window alarm's 2.5 grand plus the control panel, 2.5 grand. So that's like another 5 grand. So now at 26, now at 31. Plus as well, we had to have a fire curtain. So there's 3 flats at the back and their exit is through a side door, which basically passes a flat window.
Right.
So obviously if there's a fire in the flat, it penetrates the window. So obviously we have to have a fire curtain. That was another 4 grand. So of 180 grand of bill cost, there's 40 grand of bits there that we didn't really know we needed.
And I know it's 220.
Yeah. And, we're coming to the end of the project. Actually, the build cost still looks like it's relatively there. So we have done quite well. But, on those big developments, I mean, you can start, the cost can really start, running away from you.
Yeah,
so,
massively.
there is always something. So again, from your side is, contingencies, isn't it? It's all about contingencies.
So many people going into a project think they don't need contingencies, even on, professionals.
Especially if they add out.
Yeah. We say that all the time. Oh, don't worry, my mate Dave's an architect and all of that. I'm like, no, but you're missing.
No.
There's another 5 of a big.
I was about to say it's building control,
Daylight
sound
sunlight
test.
that you mentioned.
Daylight and sunlight is 1,500.
Part of all of it.
There was someone said like a development we were looking at, only like a build that's 2 flats. It failed because they needed to do like a sound, like an acoustic test from the outside. At a price 2 grand.
It's mad.
Yeah, always professional fee. You can lose even on the small developments 15, 20 grand on professional fees.
What was the asbestos cost that we saw?
Yeah, so we spoke about it as well, didn't we? On our project, the asbestos, we had prices ranging from 17.5 grand to like over 50 grand.
Yeah, well,
It's
I
like
need
an
that
asbestos.
contact.
So yeah,
because
So it's 17.5 grand, but then you've got to get the asbestos report done. That's £1 grand, and then you could do all of this because from a development side, we've done it pre-completion, pre-buying something on loads of different. We've tried different strategies, but sometimes you could spend 20 grand or a hell of a lot more before you buy. So it's like, what do? Do you do it all before you buy it and then get really scared? No, I'm not doing the deal. Or do you get in and make sure you've got contingencies?
I've just done that. I mean, I've just blown 10 grand by I mean, I did everything right, but actually it was actually turned out to be the wrong thing to do. So basically we were looking at another commercial to resi site.
Yeah.
And, they were like, right, we must sell and it must be by that date. So I was thinking, okay, well, we'll jump on it then. It was like subject to prior approval being granted. So we jumped on it, down there, measured survey, architect drawed up really nice scheme. We come with like 10, 11 flats. Right, we're ready to submit. And we did the daylight and sunlight assessment. That was another 15. So we probably spent it wasn't quite as 10, it was probably like 7 or 8. So right, we're ready to submit, hand in, and then it was something in the exclusivity agreement that said, if they pull out during that period, they'd have to reimburse us our cost, which is a pretty normal thing to do.
Yeah.
They were like, no, we're not doing that. And then literally, as we got to a day to exchange, they went, actually, we're going to develop it ourselves. So we jumped through all of those hoops. And you just like, you think, I'll just throw that money up the wall. So going back to it was an opportunity. I couldn't wait because obviously it had to be, but then I spent out and incurred costs when I didn't really have a position.
That's interesting.
There's a lesson in that, I guess.
What is the lesson? Because we've seen developers go through that and either get an option or an exclusivity. So what was the issue with? Would you say you would not do an exclusivity agreement again? Would you do an option agreement or would you exchange first? How would you structure that?
We would, from memory, we were doing a subject to planning. And what happened was we moved so fast in that process to get ready to submit planning that the solicitor wasn't ready to exchange contracts.
Right.
So I said, well, I want to put planning in now because obviously you need to sell it in time. I want to put planning in now, but the legals aren't ready for exchange. So how about you a quick exclusivity agreement, which can be a 1-2 pager to say you're selling, like that will just bridge the period until exchange. And it was when we started agreeing the terms of the exclusivity, saying, well, look, if you decide to pull out before we've actually physically exchanged, you'd have to reimburse us our cost that we've incurred, because that's quite a normal thing to do. And they started saying, oh no, we wouldn't do that. And then like the alarm bells start ringing, thinking, surely you would like reimburse the cost, because otherwise why would we have?
But even that though, if you spent 10 grand and you speculated the 10 grand, someone in 2 months goes, thanks, I'm going to build it out and I'll just give you 10 grand back.
Yeah.
Still, approval isn't hugely risky, but that's still frustrating. I've spent money. Oh, I'm going to refund you. I've spent a lot of time, effort and energy to get it.
I think I'd wait until you got a position. I mean, I have jumped the gun slightly again. I mean, the one we're exchanging on today, I've had a measured survey carried out, and also we've done the asbestos survey. It's only probably come to about $3,000. The architect went to me the other day, should I start doing the drawings on that? Went, just one minute. And just mistake again. Just wait. But, you know, there's a certain amount that needs to be done, because again, if you're going to be buying the building and exchanging on it, you need to know what the asbestos is. So you're like, well, I need to get that done. So I think there's always a bit of a funny period with deals, isn't there? But what I would say is, try and get a hook or a position before you really incur a load of cost. Don't go throwing a load of cost or something if you haven't got a position.
It's hard because we have it on that level, and we also have it on we'll get a schedule of works, and you're like, if it's especially on new build, but even on conversion, you don't know what steel tonnage, you don't know all of the little intricate details. So our conversation with clients sometimes is like, you're going to complete on this. You've got a 12-month facility. You're borrowing 500 grand for the works, but it's not design ready. So you've got to get in. You're probably going to take 2 months to get, asbestos survey, engineers, calcs, etc.
You don't know what else you're going to uncover.
You don't know what else you're going to uncover. You don't want to do a contingency because it changes your cost to go in. But also you think you're still going to deliver it in 12 months when you've probably got 2 or 3 months like mobilization at the start. But this conversation shows you need contingency on time and money.
Yeah, absolutely.
Rather than just going, I'll build it. I've got a quote from Dave down the road to build it. As soon as Dave gets in there, he's going to put it to pieces because he hasn't got all of the information. I think that's the lesson,
I think the contingency also changes in this market depending on what your exit strategy is as well. Obviously we only develop to retain, so rent out retain. So obviously we're only reliant on the valuation and the refinance. So time scale, not so much on the exit, but if you're selling, I mean, in this market, it's
time scales can be tough, and if you've got bridging finance or development finance breathing down your neck, you're either going to need a development finance exit to go with a new lender that can give you more time, or get an extension from your current lender. But how much more time do you need? Like, who knows how long it's going to take to sell another 4 or 5 flats?
That's obviously a question for you guys. I mean, in this sort of environment, what are you seeing in terms of exit? I mean, are developers refinancing retaining, or
there certainly doesn't seem to be loads of like young Mitch Nunns buying a flat, which is frustrating.
No, I mean, I'm personally seeing the majority of people retaining. I don't
as their like secondary strategy because they're not selling, or
no. Right. Main strategy has been to hold and refi. Maybe that's because they already know the market's a little bit tougher. Or whether they're just telling me that and they're going to try and sell, but refinance is their backup plan. I don't know, but certainly refinance seems to be what most people are doing at the moment. Is that what you're finding as well?
I think so. Yeah, like a couple of conversations we've had is about, like, especially on development stuff, if you're buying something with planning, there's usually not, in this market, there's not enough margin a lot of the time, unless you're taking it through planning yourself, to exit and get money back. So I spoke to a developer the other day, and it was about like what proportion should he sell and not. So on a, let's say, 20 unit scheme, but okay, should we sell 4 and retain 16, etc. So I feel like the conversations are evolving, but with development, like you could have one site, especially where we are, you could have one site and you could have 5 or 6 developers all chomping at the bit for it. So it's quite a saturated market with not enough opportunity. So some people are working off like 10% profit on cost. There's not enough to refinance. You're leaving so much cash in. So I think, it's a bit, I agree. A lot of people are looking for the refinance route, but then it's like, when you're doing the financial modeling, does it actually work, and how many How many can you physically retain yourself?
Yeah.
But on the conversion stuff, I think where the cost, if you're buying a new build site for £500,000 and you're spending 3 million on it, like that weight of build cost versus purchase price seems to make it quite tough. Whereas if you're doing a conversion, you've got quite a lot of tangible value in the building versus the build cost.
Yeah.
And that, I don't know if it's what's been apportioned to purchase price versus build in conversion that makes it easier, or I don't know, they yield better.
Yeah, or just the cost is less.
Yeah, like your strategy is obviously working really well with margin, but it doesn't work as well in the new build space.
No. So I guess it comes back to build cost, isn't it? It's probably one of the main
that's
factors.
probably it, yeah.
Always build costs, always, all the time. But thank you very much for joining us today. It's been a pleasure having you on.
Thank you, boys.
Thank you. And thank you for joining us on another edition of Finance and Foundations. Thanks very much.